Thanks, Tom, and thanks to Piers for the introduction to the sector. The purpose of my presentation is to talk about our investment in regulated assets, and rather than giving you a pitch on the firm, I'm just going to focus on a couple of case studies with a view to reinforcing some of the points that Piers made about why the regulated sector in the UK is an attractive one for inward investment. Firstly, by way of background, let me say a few words about Dalmore. We're a specialist in the infrastructure sector in the UK. The main feature that you need to understand about our business is the nature of our investors. Our investors are pension funds and insurance companies who have an appetite for low-risk infrastructure. Therefore, our focus is on finding infrastructure opportunities where there is very limited volatility. And the two key markets for us in the UK, as a consequence, are the PPP market, so transactions such as the one described by Hitachi earlier on, the IEP transaction, and also regulated assets. So the firm has approximately 2.5 billion of assets under management, about 100 assets, the majority by number in the PPP sector, but increasingly the majority by value are in the regulated sector. The next slide just shows a few awards that we've won. Many of these awards relate to the first project that I'm going to talk about, which is the Thames Tideway project. Now, the Thames Tideway project is a sewage treatment project which is designed to deal with London's sewage treatment issues. Obviously, London is a very old city. The sewage network was built in the 1860s. It was a fantastic engineering feat for the time. But unfortunately, the population of the city has multiplied by about 5 times since it was built. Now, it's a combined rainwater sewage system, and the rather nasty picture on the right-hand side is of the overflows into the River Thames. So the problem that we have at the moment is that approximately 40 million tonnes of raw sewage goes into the River Thames every single year because the gates have to open when it rains. Now, the solution to this issue has to be built around the River Thames. So the solution is a tunnel which will deliver that sewage to a sewage treatment plant which is operated by Thames Water. Just briefly looking at the layout, unsurprisingly, the tunnel will follow the river. It goes from Acton in the west of London to Abbey Mills in East London, and from there is an existing tunnel which has already been built, which will deliver it to a sewage treatment plant in Beckton, which is operated by Thames Water. And I think one of the consistent themes is the desire of the UK government to construct regulatory regimes and PPP structures which make it attractive for investors who want low-risk investment. In the case of the Tideway asset, they've designed a bespoke regulatory system. Ultimately, this will become a water utility, like all of the other water utilities in most respects. So post-2030, it's a normal water utility operated or regulated by Ofwat. At that point, from an investor perspective, it will be the lowest risk utility because there's very little to do with it. It's a gravity-fed tunnel. We don't put the sewage in. We don't take the sewage out. We don't treat the sewage. So there's very little maintenance or capital expenditure required once the tunnel has been built. Now, the first important thing from our perspective in the regulatory system is that we have no exposure to the volumes. And that's a consistent theme throughout regulated assets in the UK. It's constructed so that you don't have an exposure to market risks, you don't care about pricing risks, and you don't care about demand risk or volume risk, and therefore you've got an investment environment which is very low risk. In this case, the other key issue for us related to the construction and engineering aspects of the project. Obviously, it's a massive undertaking to build this 25-kilometre tunnel. But here again, the government has designed a mechanism which means that the exposure of our investors to construction risk is actually quite limited for reasons that I'll explain in the next slide. The peers explained the essence of the regulatory system, which is one based on the regulatory capital value multiplied by allowed return. For the Thames Tideway project, the allowed return has been set for the period up to 2030 as a result of the competition that we participated in. And post 2030, it will get set in the same way as all of the other regulatory assets in the water sector every 5 years. And the asset is expected to have a 120-year life over which it will be depreciated. The next slide, I suppose, just summarizes the investment proposition from the perspective of our investors. And I won't go into a lot of detail on this, but there are two charts on the slide. The one at the bottom is pretty much self-explanatory. It shows the yield to our investors over the first 10 years. And again, this is one of the important features of the bespoke regulatory system for this asset. It has been set up so that it has a yield from day one. So the users of water in London are already paying for this system. Now, that's not necessarily bad news for the users of water, because originally, when the project was being developed, it was expected that this would add 80 to 100 pounds to every water bill. But actually, as a result of a very successful procurement process, it will add approximately 25 pounds to all of the water bills. So it offers good value for money to the users and to government. The slide at the top is a little, or the chart at the top is a little bit more complicated, but it shows some of the sensitivity analysis, and it attempts to explain why the asset has low volatility characteristics. And I won't go through all of the sensitivities, but the key one from our perspective is the construction risk. And there are three main reasons why our exposure to construction risk is limited. The first one is that the asset has been set up so that we have a large contingency in place for construction overruns. So the expected build cost of this tunnel is £1.7 billion, but we have a contingency of almost 600 million built into our base case. The second feature is there are various sharing mechanisms with parties in the event that there's an overrun. So our contingency is only designed to cover our share. So there's sharing with the contractor, there's sharing with Thames Water, and ultimately there's a sharing mechanism with the users. And the third aspect is that the regime is set up so that the impact of any overrun, which is unlikely given our contingency, is essentially deferred until after the first regulatory review in 2030. So that means that when we model a very severe sensitivity on construction price, spending an extra £1 billion, which is very unlikely, it has very limited impacts on investor returns. And when you look at the background of our investors, pension funds and insurance companies, that was essential to convince them to invest in this asset, and also an important factor in reducing the cost of the project to the users. If I move on in the second example that I was going to give of our investment in the sector, we have recently invested in the gas distribution sector, a company called Cadent, which was previously the gas distribution business owned by National Grid, which owns the electricity grid network in the UK. Again, I won't explain all of the details of the structure of the industry, but obviously it starts with exploration and extraction and ultimately ends with the delivery of gas to the end user. Our bit of the business is focused on probably the most basic element. So it's the pipework that delivers gas to the end user. So it takes gas from the national transmission system, which is still operated by National Grid, and delivers it to households and businesses. Again, the key feature is that we are not exposed to pricing risks. We don't care about the price of gas, and we don't care in the short to medium term about the volume of gas that is using our network. And those characteristics make this a low-risk asset also. Just looking at the the structure of the industry, it's split into various regions. The region that we are invested in is the region labelled 3, which is north of London, in some of the heavily populated parts of the UK. So it represents almost 50% of the gas distribution industry in the UK. And this is perhaps a little complicated, but it's intended to describe how our revenue is determined. And the first element of the revenue is we get an allowance which is intended to cover our operating costs and our maintenance costs on an annual basis. The second element, which is the most important, is the one that Piers described, which is the regulated capital value multiplied by the allowed return. And in the gas sector, that is reset every 7 years. We then get an allowance or a recovery of certain items. So, for example, we recover taxation under the regulatory regime. And on top of that, there are various incentive mechanisms. Now, the incentive mechanisms are designed to incentivize us to provide a good service to the end user, or also potentially to penalize people who do not provide a good service to the end user. And clearly that is the first objective of the regulator, to make sure that the service is provided well. But the important thing from an investor perspective is all of the regulators are very focused on making sure that the sector is attractive for investment. So there's a secondary obligation of making sure that it remains a sector that people will invest in, and a sector that banks and other providers of debt finance are prepared to lend to. And again, looking at it from an investor perspective, this is somewhat similar to the slide that I showed on Thames Tideway. Again, one of the key one of the important factors for us in any investment is we want yielding assets. So this is an asset which we expect to yield on average 8% to our investors over the first 10 years. And the second aspect is focusing on the limited volatility. Now, there's perhaps more volatility in this than in the Tideway asset, and certainly there's more volatility than you have in PPP assets. But the lack of exposure to market risks means that in all realistic scenarios, your volatility is probably limited to plus minus 1.5% or 150 basis points. There is, of course, an exposure to performance, but again, we feel that that's quite limited, probably plus minus 50 basis points. So, in summary, the regulated sector is one that we as an investor will continue to invest in. We're hoping to acquire an additional stake in a water asset, and we're hoping to get news on that in a couple of weeks. We will be looking to acquire additional stakes in this gas business and potentially also in the Tideway asset. And as Piers said, we look at the regime in the UK as being extremely stable. The UK has private sector investment across a massive program of PPP and also across all of its regulated assets. So government and the regulators are very conscious of the need to look after investors in the sector. Thank you very much.